Hey everyone, this is Kirk here again at OptionAlpha.com, where we show you guys how to make smarter trades. And tonight we're going to cover a lot talking about volatility crush after earnings. And specifically because we had a new trade today in Facebook ahead of its earnings this evening, which it already announced. And then we also closed out of a quick trade that we had in Microsoft, where we've literally been in this trade for I think about a total of 7 minutes and made nice little $45 profit. So pretty much a little bit of a scalp trade in Microsoft, but really kind of going over the volatility crush. And this is a great video because we're going to have a great example of a before and an after trade, and then a trade that we're putting on as well. So follow along with us in this video. I think it's going to be really great. So first, before we start off with our opening trades, I want to get to our closing trade in Microsoft, which is this closing order down here. So again, if you followed along with last night's video, we sent out an alert just at the end of the day, and I know it was just last minute at the end of the day, but that's when we got filled. That's when the alert sent out, where we got filled on a Microsoft strangle heading into earnings. And what we did is anticipating that there's going to be a big crush or drop in volatility after this earnings event happens, right? Because this one-time event, everyone's looking forward to this, and the stock usually jumps a little bit, but after this event, it's like that. It's not like there's no volatility in the stock. It's just that we are past this one-time event, and so we can go ahead and move on and things kind of calm down for the stock. So we want to take advantage of that, and the way that we did that is with a strangle in Microsoft, and you'll see that we also did that with a strangle in Facebook as well for their earnings this evening. Now with Microsoft, we went ahead and bought back the July weekly contracts, so we did trade the front month contracts, and we had the 47 call above the market and then the 43 put below the market. Now, right after the market opened today, we entered an order to close this thing out at about 10 cents, right where it was trading. So that's ideally what our exit strategy is for these earnings trades. If the stock opens within our range, which was basically around 47 to 43, and the stock opened right around 45.5, and this thing starts to decay in value very quickly, which it did within a matter of minutes, then our strategy is just to go ahead and close that thing out at wherever it is and bank the profit. We weren't going to wait all the way through the end of today or tomorrow to see if we could just keep another $10. We made $45. I think honestly we were in this trade for about 7 minutes total. So really that's a great use of our capital to be in and out of the market like that. I wish we would have done more of these, but like I said, originally the pricing on the Microsoft earnings wasn't as great as we would have hoped. Okay, so that's what happened with Microsoft as far as the trade. Here's a look at the chart of where Microsoft is after its earnings event. So up here in the top, you'll see that it did have a little bit of a pop during the day, and it opened above 45 at about 45.50, but actually closed the day lower than yesterday. So really not too good as far as earnings are concerned. And really this kind of rally before earnings really didn't lead to a big jump in earnings like many of us might have thought. But the key here is that implied volatility has dropped dramatically in Microsoft. It's now down at the 22nd percentile. Now you can visually see it down here on the chart, and I've actually kind of thrown up here an implied volatility reading here on the bottom side of your chart. So you can see that as we were heading into earnings, implied volatility was rallying really, really high. And then just today, ahead of earnings, see how crushed the volatility gets. It just drops like a rock. And this creates a huge contraction in option values. So option values are really high heading into earnings, meaning they're very expensive. And just the mere fact that earnings has happened has contracted all of the option premiums across the board. Now again, Microsoft didn't actually go anywhere basically. It basically traded exactly the same. So this really goes to show you that even exactly the same as where it was yesterday, we got a totally different price in our options between selling them yesterday at 55 and buying them back today at 10. So great example of how powerful earnings contraction can be for implied volatility, and really why you should never, ever under any circumstance trade options long heading into earnings, because that volatility contraction is just way too powerful to take advantage of. Okay, so let's go over the new trade tonight, and that is our Facebook strangle. So very similar setup with Microsoft as we did with Facebook. This time we're taking a little bit more risk because the pricing was a little bit better in Facebook. We had the strangle in Facebook. We did the weeklies as well, so they've only got 2 days to go in their contract expiration. But again, I'll show you why those options have a little bit more juice and a little bit more implied volatility, because they're part of the earnings cycle. As far as our strikes, we did the 76 call on the top side and the 66 put on the bottom side. Okay, so very evenly spaced, as far as where we are from where Facebook was trading today and kind of closed out. So very evenly spaced. The 76 call above the market, again, selling that naked, and the 66 put below the market, selling that naked. Now we took in a lot more credit for Facebook than we did for Microsoft down below. And you'll notice for Facebook, we took in a credit in total of about 132. So a little bit better trade, and we kind of scaled up here a little bit, so added a little bit more risk. But this credit of 132 moves our break-even points out even further. So it moves it up to about 77 and some change on the top side, and then moves it down to about 64 and some change on the bottom side. So taking in that credit with these strikes that we have here really spreads out that strangle for us, gives us a very wide window of opportunity to make some money. Now here's a look at where Facebook is. Implied volatility hasn't gone as high as we would have liked, but we still should see a nice little earnings crush for implied volatility just because of the earnings event for Facebook. And we've gotten a huge rally out of Facebook. So people are definitely buying the rumor and assuming that Facebook's going to jump higher after the market close, in which case it actually did. Earnings actually have come and gone for Facebook. The conference call is over, and generally everyone kind of likes what they see, and the stock is trading a little bit higher after the market is closed, okay? But we still should see a pretty good drop in implied volatility, and because we traded the weekly options, we should see a good decay in our value very quickly. So here's a look at where Facebook is. Again, we traded these weekly contracts here, which only have 2 days to go in expiration. But here's the kicker, is that the implied volatility for these contracts are 97%. You compare that with these August contracts, which are the next monthly, those only have a 46% implied volatility. So very similar to what we saw with Microsoft, is that Facebook actually has really high implied volatility for these front month weeklies, which give it a lot of extra juice heading into earnings. Now you'll notice that Facebook is actually trading at about 75 after earnings. So right here in the trade tab, you can see where it closed. It closed at 71.29 and is trading up about $4, which ironically enough was the expected move out of the security for earnings, was right around $4 or so, and that's exactly what we got. Now we were a little bit more conservative with where we placed our position in placing our spreads about the 80% probability level, and you can see that it's a little bit different now because these probabilities are starting to readjust. But as far as we're concerned, our put side trade at 66, that will be completely worthless. And then our call side at 76 is still looking very good. And remember that our credit took our premium out to about the 77 price point. So if we actually look on the risk diagram here, or diagram, this profit loss diagram on Thinkorswim, you can see this very wide straddle in Facebook heading into earnings. Now look at how wide the straddle is, and originally Facebook closed right around 71. So we were very even in where Facebook had originally closed, giving ourselves plenty of room on either side of the market. I don't care if the market goes higher or lower, I just don't want to go too high or too low, and I'm just trying to take advantage of implied volatility more than anything else. But now that that's happened, you can see Facebook has now traded out to about 75. So by trading out to about 75 right now, that gives us still a nice little window of opportunity to make some money, because we only start losing money at expiration right here at about 77.32 or so. So we have still another $1 and then some, probably about $2 of kind of wiggle room that Facebook can trade up to tomorrow or even in pre-market trading. So I feel very confident about this trade, but that's again just the nature of the game, is that the stock is going to move, and we kind of expected that, and that's why we went a little bit wide on our strikes. Okay, so the ideal, or the situation tomorrow that we want to get into, is have an opportunity very early, right at the open, to close out this trade, buy back both of these options that were short. So buy back the 76 call, buy back the 66 put, buy it back for dramatically less than 123, which is what we sold it for, and bank a nice little profit. Okay, so we'll see what happens tomorrow, see if it continues to trade in that direction or not. The other trade that we entered today is just a very simple debit spread in MCD, which is McDonald's. McDonald's has actually been pretty crushed after earnings, and all we're doing here is playing the probabilities that, you know what, at some point this thing actually might rally back up just a little bit. We've actually seen that today since we entered the order earlier in the day. We've actually had a pretty good move in the stock already, and are up, a couple bucks in the stock trade right now. But we did the 92.5, 97.5 debit call spread. So that is a $5 wide strike. So it's a $5 wide strike on that, the 92.5, the 97.5. And because it's a $5 wide strike, we paid about mid price, which was $2.50. So that gets our break-even price right at 95. And that was actually right at where the stock was trading originally today when we entered this spread. So it gave us a very good 50-50 probability bet in McDonald's. And again, what we like to see in McDonald's is just a huge rally off of this sell-off. Let me just get back to the base chart. So what we'd like to see is that after this earnings event and the stock continues lower, we'd like to see just a little bit of a move higher in the stock, kind of this dead cat bounce, right? Usually when stocks have such a huge dramatic move in either direction, they tend to just bounce just a little bit. We're not looking for a huge rally here. Our break-even price is 95, so we're already above that right now. Stock's trading at 95.35 right now, but we'd like to see a little bit more movement in McDonald's higher before we actually get out of this trade. So all we're looking for is a quick move higher, and we'll be out of this trade. It's not a trade that we're looking to hold very long unless we have to, right? Unless McDonald's turns around tomorrow and starts trading lower, then we'll hold on to this trade until it starts to show a significant profit. So as always, I hope you guys really enjoy these. If you have any comments or questions, please add them right below here in the video. If you're watching this video on YouTube or somewhere else publicly, you just have to understand that you're actually getting these alerts about 15 days after they're sent out to our members. So these alerts and this video that you're watching is sent out before it's posted publicly on YouTube and elsewhere online. So you got to sign up for a free trial at optionalpha.com. You get everything, all these video tutorials, these alerts, all kinds of live charts and economic calendars, all for free for 7 days. Go ahead and kick the old tires and look around, see if this is something that can help you become a smarter trader. As always, happy trading.